Wall Street Journal comes out last week with this big article that says there's 500,000 more sellers in the United States than there are buyers. And one of the fascinating points that it pointed out was that since 2020, houses nationwide have appreciated by 50% on average.
We all agree that there's a chance that this market's going to take a turn, right?
I mean, it's going to
take a bad turn, take a huge inventory surplus.
My prediction, and I think it's a ballsy prediction, but I think from June of 2025 now to June of 2026 next year, housing prices nationwide are going to drop 5%.
I think we're going to see a lot of consumer confidence. I think we're going to see a lot of things that are going to change. I think we're going to see tax cuts that are going to affect people's bottom line. We're going to see lower gas pump costs.
There's massive tailwinds on the fact that we are 4 to 7 million homes short in the United States. I think it's going to be a correction. I do think that over the long term, housing prices are going to continue to go up like they have over, since the beginning of time.
Welcome to the Cashflow Quest. We're curious if the housing market's going to get bombed. There's a lot of clickbait on the internet right now, and so it's like, well, okay, let's open this up.
Yeah,
let's check it out. We're making some internal bets across the team, just as around the lunch table kind of a thing.
Yeah, and I think too, it's like there's noise, but then for me personally, and let's go through the bet that we're talking about, then maybe we can unpack it. For me personally, I just have noticed around all of our neighborhoods, there is so much more inventory. There are so many more homes for sale. There's homes that were sold at crazy price points just a year or 2 years ago that I'm seeing back on the market with just like $20,000, $30,000 more. They're just sitting there idled.
Mm-hmm.
And
it's really odd.
Yeah, it is odd.
So they didn't get the benefit of the 3 or 4% rates.
No, they didn't.
Their values, they're maybe going to lose money on the house.
Correct. Yeah, correct. And
because they're not sitting there pretty. They got a big payment.
Yes.
Versus people that are at 3%, they're like cruise mode.
Yes. And then in the Wall Street Journal, where this kind of all came up, I noticed this, just like driving, like, oh, I've seen so many more houses for sale. Mm-hmm. And then the Wall Street Journal comes out last week. It was last week or the week before with this big article that says there's 500,000 more sellers in the United States than there are buyers. So I read through this article, and one of the fascinating points that it pointed out was that since 2020, houses nationwide have appreciated by 50% on average. So that was
since 2020.
Since 2020. That's only 5 years ago, 50%. And so I'm sitting there thinking, I'm like, okay, well, since 2020, interest rates have gone from 3 to, I think the median now is 6.5. Mm-hmm. So I just quickly ran that math, right? So say you bought a house for $500,000. Let's just say it's the mortgage, right? Mm-hmm. The mortgage is $500,000 in 2020. Your interest rate is 3%. Mm-hmm. Today, that same house is $750,000 at 6.5%. Mm-hmm. So what is the affordability on that mortgage payment? Let's move aside anything with taxes and insurance. Let's just look at like monthly, a 30-year amortization schedule and what that payment is with the mortgage and the interest.
What'd you find?
Yeah, it's more than double. So it went from $2,100 back in 2020 to that same house now is $4,700. So it's more than doubled on the monthly payment. And then you combine that with the fact that during this time, people took on a ton of just personal debt, right? Credit card debt, it's at all-time high, buying cars, whatever it is.
Mm-hmm. They lost their butt on their Teslas.
Oh yeah, I've lost my.
Hey, watch it.
Hey, we got 2 Tesla owners here. I love my Tesla.
I was gonna buy one of those for a golf cart just because it's so cheap.
Yeah, I love my Tesla, but yeah, there's no way I'm gonna make anything on it. It's like, yeah, that is a fully depreciable asset.
Yeah.
But to like my point is that now you see all this inventory. I was on the phone yesterday with a big San Diego realtor who's also an investor friend of ours, and I was just chatting with him for about an hour.
I wanted to hear about this.
He's been in the industry for, I don't know, 40 years, like, long time.
Yeah.
And he said, I just asked him, I was like, what's going on? What are you seeing? And like, this is what I'm seeing. He's like, yeah, it is tough out there. But he was excited because he's like, this is when the experienced realtors actually make money, because everyone makes money when everything goes up. But was saying that there's, inventory sitting, people want concessions, and it's very difficult to get something into escrow. And even when it gets into escrow, it's falling out. So
sellers are holding still. Or what was the consensus on
Yeah,
like how's he
so-
making deals happen?
Uh-huh.
Yeah. So to his point is like, this is where the experienced realtors come in and say, hey, look, to this exact point you just brought up, you bought this house for 980, right? Let's just say 980,000. You're trying to get $1 million. I'm telling you, a good deal right now is to sell this thing for 970,000 and be happy, and making your client feel like you're making the right decision. And you talked about all the personal debt and everything like that. And that's where you need to break it loose, is you need to get, and it will happen with time because of that mortgage payment you're talking about.
Yeah.
You cannot just sit on all this inventory, right? If they need to sell this house, well, there's going to be an equilibrium that's going to come where buyers and sellers are going to meet and things are going to start to trade. Now, I think that's going to take a couple of years, at least a year, to start to filter through. But my prediction, and I think it's a ballsy prediction, but I think housing prices are going to go down 5% year over year from June of 2025 now to June of 2026 next year. Housing prices nationwide are going to drop 5%.
Nationwide.
Nationwide.
Our bet was San Diego.
Our bet was San Diego, but we could broaden it. But my bet was San Diego.
So for the next 12 months, you think that the average home price is going to go down 5%?
Yeah.
I think there's a shot if a lot of people ride this, call it the fear trend of that, and they start listing their houses and they want to get out.
Well, if there's
That'd
more
be
inventory,
interesting.
yeah. And there's a lot of inventory starting to pop up.
How do you measure this? How are we going to measure this?
Yeah. How?
We're going to have to we should grab one,
Big average.
Yeah, exactly. And stick to that one, so it's apples to apples when we look over it. 12
Average
year
home price today versus.
Tide thinks they're going to go up.
I do. And the reason I think that is because I feel like we've been spooling up economic downturn. There's been a lot, like inflation's been on a run. There's been all these things that have been hurting people's pockets. And there's a big, beautiful bill that's about to pass. And I think that we're going to see some changes. I think that the whole point of Donald Trump's presidential campaign was that he wanted to kickstart the economy. And that's about to happen. So I think just writing that off. Yeah, I think
so purely based on consumer confidence, basically, right?
Well, not just consumer confidence, but I think if we do all these different things that are going to like, for example, we're talking about energy, for example. He wants to become the number one world exporter of energy, things like this. If Americans start having more money in their pockets because at the pump it's less, there's more opportunities in all kinds of different places that he ran off of. I think if we see the economy start spooling and people are making more money, they're not going to be selling their house for less. But we haven't had that yet.
But you just said that if inflation keeps going up, and it's going to keep going up, that people are going to have less money. Even if they're making more money, things are more expensive. So,
okay, does that make the house more expensive or less?
Well, I'm purely talking to math. I'm talking about math on the affordability with interest rates. I don't think the Fed is going to come and save the day and slash interest rates. Like, if they do a cut later this year, I think it's going to be modest, 25, 50 basis points. That's not going to have a big move on a 30-year, 30-year loan. And I think that we pulled forward so much appreciation given the COVID times and the fact that the Fed was increasing rates, then COVID happened. They slammed them back down. And so we've just created this problem. And yes, there's 7 million or 4 million or whatever number you want to pick from the Fed that we're short. We have a shortage of housing. There's no doubt about that. But I'm just looking at purely that example I gave. I think tells you everything that I do not continue to see. I don't think that housing prices in the short term are going to continue to rise.
So when we talk with investors, something we're really excited about is bonus depreciation coming back. What do you think that that's going to do to, let's just use multifamily values? Do you think multifamily values with bonus, when everything gets lit on fire, do you think those are going to drop?
Nothing's going to really change multi.
Yeah, multi's already going down. It has gone down.
The multi has a separate issue, which is absorption in a market that had new supply over the last cycle, 3 years. Right. So interest rates will swing multi. A big, beautiful bill won't.
Well, okay, but if bonus comes back, we know deals are going to start happening, right?
Well, we love it, but that's very industry specific.
Okay, but so you'll
sell more cars potentially to smaller businesses that need the write-off.
Yeah,
airplanes maybe again, tractors, equipment. Trump's trying to stimulate dollars and get the velocity back.
And I'm betting on that if it works.
But I think that in my argument here is that I think it takes longer than you're thinking. I would say it takes 2 or 3 years, even when this bill passes, for the real economic benefit to
really
like the
catch
engine
momentum.
to get up to RPM.
You know,
like
our bet's a year.
Yep.
Yeah.
And what was your percentage?
I took like a slight decline of like 1 or 2%.
I think it was 1. I think you were 1. Michael was 2. You're 5. And I'm positive 1.
Yeah. And we did pick San Diego just so we could measure it, which is a very nuanced market because there's not a lot of supply here. You can't build houses here. And an average home here is like closer to $1 million. My mom bought like the only little townhome condo thing that was under $100,000 in our area.
Well,
and it was crazy.
What's
like
interesting to that point is you're seeing right now a couple of thoughts are coming to mind right now, but like the inventory when it's coming on, it's on the market for longer right now. Like we were looking at some listings that have homes being on the market to be sold, and the listings were like, geez, this house has already been on the market 26 days, 47 days, like where before,
dude, it was like a week.
You
3
know,
weeks.
the $950 purchase price, or even at like $1.1 million, like in San Diego specifically, like those homes were moving much faster than that when there weren't as much inventory. But I feel like because there's more of a supply right now, there's variables happening. People, are still like, I don't think interest rates are going to come down much. Everyone was like waiting
Well,
for
it's like
something
7
to happen.
G's to buy that place.
And
a
it's
month.
expensive.
It's a lot of dough.
Yeah.
Yes.
And
Like,
so
okay,
it's
so-
really interesting. The inventory isn't moving as quickly.
When did you sell your previous house?
2 years ago.
It was actually right behind the peak. Right on the other side.
2023. Which we hit, we sold and as interest rates had peaked and were coming down slightly, but they were still in the sevens.
So how much do you think you're like, did it vary? Is it on the market for more or less?
It's on the market for about $50,000 more.
Yeah, that's what I'm saying. They're just edging up. I've seen
close.
the same thing. It's
I
too
don't think
close.
they're going to get that.
Exactly.
Yeah.
And we'll see what they
Because
get.
the payment is ridiculous.
Right.
Mhm.
Like-
And we were looking to see, okay, well, maybe they made more improvements to the house and they haven't done anything. They actually removed a couple of things and
I think
painted
you're
and
gonna
like,
lose.
that was it.
We'll see. Look, we all agree that there's a chance that this market's going to take a turn, right?
I mean, it's going to
Take
do
a
something.
bad turn.
Hold
Take
on.
a huge inventory surplus. Turn.
You said
think-
we all agree now. Are
Well-
you jumping on the boat?
No,
I'm 1%
He's
positive.
saying for-
Hold on. Let me articulate.
Fun with the anger
Let me-
is
let
building.
me-
Yeah, I love
I'm
it.
throwing you on a life jacket.
Yeah, you ain't throwing me nothing. Look, we're here talking about how this new tax bill is going to generate all of this movement and all of these deals are going to be done. Now, obviously, in our
What deals? Sorry, just be clear.
we feel like a lot of real estate is going to start moving. Like a lot of big groups are going to start trading.
We're talking
deals.
residential though. Residential. homes.
Hold on. If there's a lot, the tentacles go far, right? So something that's going to be good for the goose is going to be good for the gander. We're going to see. I don't think it might be as on fire as the MH industry, but that's because the bonus is so much better here. But there's still benefits to multi. There's going to be, all I'm saying is
Movement,
we're
forward
about to
movement.
see movement. Yeah. So it's easy to make a prediction of catastrophe when we're stalled, right? But when we have a new spark plug about to be put in, maybe the engine misfires and it doesn't happen. But if it does, I think we're going to see a lot of consumer confidence. I think we're going to see a lot of things that are going to change. I think we're going to see tax cuts that are going to affect people's bottom line. We're going to see lower gas pump costs. I think we're going to see a lot of things that are going to stimulate the economy.
All right, so you think in broad strokes that the let's say the expense load of a given working class person, even white collar, higher income, 100, 200K earner is going to end up with less cost
yeah, I think we're
and
going to
more
have.
confidence.
And
Correct.
even though inflation's still climbing potentially, with the less cost, there's still going to be a surplus between the two.
but
to
like-
that they'll
We also know that large groups are getting in even heavier into residential, where, we all hear about how groups like BlackRock, Vanguard, State Street are buying up residential. Like, I just don't think that.
That's been kind of stalled out though.
Yeah, they're not buying
but-
them at these prices.
But right now we're stalled and we're about to see some changes and there's a lot of money parked. So I think
But the
that's
key for specifically real estate capital is the 10-year treasury.
okay.
That is it.
Okay.
If the 10-year Treasury moves substantial, up, that's bad, down, then capital will come off the sidelines. There's been like this intermittent pencils down holding. And that's where like, I agree. In like most of our life, I'm excited that the bill that Trump's trying to pass will help stimulate the economy in general. But I still think inside of a year, I still think there's tons of risk factors for housing, residential housing specifically.
We do agree that if the 10-year comes down, that we're going to probably see houses do well, right? They're going to continue to grow in value.
Oh yeah.
Okay.
If the 10-year comes down and spreads come down, because even with the 10-year at 4, let's call it 4.4 right now. Jonathan can look that up.
It's 4.4. It's 4.3.
4, yeah. So even it's 4.4. Like I just said, 6.5% is your average mortgage rate. That's a massive spread. And so the reason why that spread's baked in is risk. And so the spread needs to come down between what banks are going to be able to lend for a 30-year mortgage. That needs to come down, but then also the 10-year Treasury needs to come down. But even if the 10-year Treasury comes down, it's not like that spread is way too high. And so that's where it's causing that affordability. And that spread is baked into risk that people do not want to put 30-year paper out with the thought that there could be a chance that interest rates are higher.
So we do agree. So like Scott Besson's come out, he said his number one focus in this role is lowering the 10-year Treasury in his term. So right now we're arguing semantics. We're talking a timeline issue, right? You're agreeing with me that houses are going to go up in the next 5 years.
In the long run.
Your argument is within this year. So we're really just talking timing.
Yeah.
All right.
So
the
bet was basically a year. Yeah. And so I do think that in the short run, their housing prices are going to drop.
I think you're wrong.
All right. I think we keep going though, because we're having fun arguing over the 1 year, but I think it's important to give a 10-year outlook because we're kind of hyper focused on a couple of things.
And it's playful. Part of this is like, I'm drawing a line to be the devil's advocate and putting a bottle of bourbon on it. It's not a big deal. I think that we might see them in the short run, like maybe in the next 5-6 months, maybe it changes, to and fro. But I think in a year, I think we're going to be seeing some drastic economic changes that are going to benefit values on houses. That's my thought.
Fair enough. Okay. It's a bet. And then I'm curious, like, okay, now let's remove the bet from the picture.
Okay.
I think that the tax bill will, like, let's say, jumpstart a stalled economy, and also the perception and like consumer confidence could start to move again. I feel like the bad news bears on the media has been kind of playing on repeat. And so people are pulling and really being cautious with their spending. Also potentially over levered. Potentially now they're paying $7,000-8,000 a month for a house they bought in the last couple of years.
Major conflict in the Middle East is happening constantly. That makes people, concerned.
There's a lot of dynamics in the bad news cycle and or on the bad news consumer confidence side. So I'm hopeful that this kind of jumpstarts consumer confidence. People want to come out into the sunshine again and start moving. And my theory is that it takes a couple, 2-3 years from now, even with the tax bill passing, to kind of see what this happens. The media is fighting it. So like, let's put the foil hat on for a minute. The media doesn't want Trump to win. Seems like I just don't think it's a square win when it passes. I just don't think it's going to be like, boom.
Right. But we're in June. It's supposed to pass the 4th of July, and it's the 25th of June. Right.
God, so bless him if he gets it through.
So it's about to, but it's looking pretty good, right? Everything I'm reading is like, it's probably going to go through. So the real question is it going to, in 12 months, buy me a bottle of bourbon? That's the real question.
Well, no, but I think it's important to we can come back to it, but like, I think it's important to think like, okay, let's say consumer confidence and spending and people go out and spend more money on retail and stores and whatever. That's going to move the needle, but that doesn't solve the affordability, which is Ben's point.
Yeah. And I think too, like that's the short run. And I do think that it's going to drop down, but like there's massive tailwinds on the fact that we are 4 to 7 million homes short in the United States. And so while this will be a correction is what I think it's going to be a correction. I do think that over the long term, housing prices are going to continue to go up like they have over, since the beginning of time, right?
And Doge didn't fix it.
No.
Quantitative easing is not going away. Those houses are going up.
But it's going to come back.
But to my point is that I think that it could be a really unique opportunity. It's not here yet, but it's going to take time. There's lag. There's a lot of lag in the market. It could take, I'll give you an example. The 2008 financial crisis happened, right? People were starting to go foreclosing on how, that started happening in 2005, 2006, 2007. You finally had this big break, the tipping point. Housing prices didn't hit the bottom until 2011, 2012, before they started to rebound and go back up.
4 years.
It could almost,
I think we're potentially in the start of the dip. I think there's a good data point. 2023, Jen sold a house. And now it's back on the market for $50,000 just because they want to close and break even.
Yes.
I mean,
Jonathan, can you give us some data? How much did the housing values drop during the great financial crisis? Percentage. I'm curious because 5% is a lot of money.
I think they drop. It depends. Yeah, you're going to probably you have to look year over year, but they drop 20%. In some places, 30, 40%.
Let's do San Diego, seeing as I got a bottle of bourbon while riding on that.
Yeah. Oh,
for how long?
Well, and I think that's an interesting point too, because when you go to nationwide versus San Diego, it might only dip in San Diego 5%.
San Diego got cream too.
It
was us in Vegas. I think
you're going to see much lower dips.
And the only last point I'd make is that this time is way different than the 2008 financial crisis, because that was a credit crisis that was really manufactured.
Right.
And to your point that you're saying, I mean, the stat keeps going down because people refinance, but let's just put it at 70% of all 30-year outstanding mortgages are financed at 4% or below.
That's
right?
insane.
Which is why nobody's
It's a completely
selling.
different issue.
It's a totally different issue.
And then the volume of homes transacted as rates went up were very low. Pure numbers, there are not that many homes that sold with 6, 7, 8% interest rates. Everyone moved and got in at under 4.
Yeah.
And then everyone held.
Yeah.
You'd be kind of stupid too. If you had any issues with your job, you'd be stupid to sell that home if you have a 3% rate.
Yeah. And so that's a great point. Just that, and I don't mean to talk the whole time, but it just popped up in my head. So then going back to, it's a great deal if you maybe take a 5% less. What if it's somebody that wants to retire, right? And they're in San Diego. They've owned their house forever. It's free and clear. They bought it for $100,000. It's now worth $1 million.
Exactly.
Do you really give a crap if you're going to sell it for $1 million or $950,000? No, you say no. Just say, hey, bro, if you can get it done at $950,000, sell it. We got a house in Florida we're going to, or we got a mobile home and manufactured home in Phoenix that we're going to, and we're going to go retire. It's only the folks that bought recently, the ones that we're talking about. So when you said that, it was that's the kind of. And
that's a really good point, because I've been noticing as I've been looking at inventory, it's older homes that they didn't buy this or get a loan 4 or 5 or 3 to 5 years ago. They've had these homes for much longer. Now they might have refied, right, and gotten a lower rate, but there's equity in that house. It's been there, it's sitting there, or they don't owe anything. And so I'm noticing a lot of older inventory.
Yeah, there's a few in my neighborhood that are
turning.
Ooh, that one needs a lot of work. That just got listed and they're wanting 1 point whatever.
Yeah.
And it's
and so
good luck.
My old house is a unique kind of case, but that's happening. But
I think he's
seeing
right.
more.
You're going to have both. You're going to have the people that don't really need the home run crush it because they've been in there forever. Because I'm seeing those same homes get listed.
Yeah.
And then it's the ones that's well, wait a second. That just traded a couple years ago.
Right.
And those people are in the pain.
Yeah.
I think
that's
so.
pressure.
I think
they're selling because they have to. They can't afford the mortgage or whatever the case is.
No, and so now you're seeing the accumulation of sell while you still can get a decent price from the people that have historically been there for 30 years.
Right.
And the people that bought in the last couple of years and now are like, oh shit, we shouldn't have committed to this $6,000-$7,000 a month.
Mm-hmm.
Yeah.
Mm-hmm. So.
Well, I mean, that pretty much covers it. I mean, we think that in the end, we're going to have a little bit of a bumpy ride. I made the analogy, if you've ever been river rafting and through rapids, that we were all in this weird calm, singing Kumbaya, maybe even a little bit of Nickelback or something, just thinking about it.
Yeah.
And then now it's wait. I hear some turmoil. I hear some water. And I feel like we're going to go through a couple of 2-3 years. I bet that the home price maybe dropped a tiny bit. in the next year. But my broader prediction is that we're going through a slight ripple for the next 3 years, and it could bumble along and down. I don't think we're going to see a huge price increase inside of 3 years. I think it's going to be bumbling. Maybe it dips a little bit. Maybe it dips and then comes back up, just because of San Diego specifically doesn't have any inventory. And then like the butterfly, back in the hills where they're trying to build more homes prevents them from building thousands of homes. Environmental issues.
There's going to be a supply.
There's things that are just really bottlenecking supply in California. And so that, you might just have enough demand and enough high earners to outpace that. But I think it's going to be interesting.
Well, if someone's listening to this and has an opinion on it, like reach out to us. I would love to hear other people's opinions. Reach out. We'd love to hear what you're kind of seeing in the market, because this is just our observation from our kind of little corner
He's the
of the
MBA.
world.
I just manage trailer parks.
We could have a couple of our hot rod realtor buddies come on
and talk about
this.
it. Because it'd be interesting to hear what they have to say. A new guy's, opinion versus a seasoned realtor's opinion. It would be interesting.
The other thing is, do we think that there's a chance that there might be a fluctuation in rates in the next year? Do you think that rates potentially could go down? It seems like it's constant pressure. Trump was like, I don't know if you guys saw that interview yesterday or the day before. He's like, I've tried it all. He's a very stupid person. Yeah. I've been nice. I've been rude, and rates just don't come down.
Yeah, I do think that the Fed personally is behind the ball, and they need to cut rates. I think inflation I'm not talking about you go to the taco shop right now and it's $17 for a burrito. Like I get that. I think that's already here. But if you just look at
crazy,
but if you look at just CPI, which is kind of a wacky figure anyways, the way they measure it. But I do think inflation is starting to come under control, and you've seen that with the last couple of prints.
2%, 2.8, something like that.
Yeah, and then so I do think the Fed is going to cut slightly this year, but it's not
tight or bend.
I don't think it's going to move the needle.
I think there's kind of this weird perception here. So if the Fed cuts rates, they cut their overnight rate. It's SOFR, secured overnight funding rate. That doesn't necessarily always correlate with the 10-year Treasury.
Because they're not in lending. They're not always, sometimes they pre-price that in.
It correlates with the front end of the curve, essentially. So the Fed funds rate, SOFR's tied to it, and all of these other things, but it just cuts the front end of the curve.
Which is the short term.
Yes, but to Blake's point, the 10-year Treasury is a different beast. That's really supply.
Bond buyers. You need 10-year Treasury buyers on scale to move the needle.
To move it down.
Yeah.
So honestly, the wars, as horrible as it is, that is more than likely going to drive the 10-year down more so than the Fed reducing rates.
Correct.
So it's a weird animal right now. So like, it's funny to me that they're leaning on Fed chair so hard over the overnight rate.
Yeah.
Because it's not going to move the needle back.
Because they have a bond buyer issue on macro.
Yeah. And I think, and it's more too, it's like what I think drives the 10-year is not necessarily like, it's more of the perception of the Fed policy going forward. It's not like one cut. It's like, are they going to go into a easing cycle where they're going to continue to cut, and that can drop down the 10-year Treasury, because then people will say, from a
risk is the Fed is confirming our risk.
We're heading into a recession. If the Fed is getting ahead of and starting to cut the rate, it's indicating that a recession is here or on the rise.
Right.
Probability of it being on the rise. And so that would drop the 10-year Treasury, but them just doing a mediocre cut and saying, hey, we're just doing, 25, 50 bip, like a 25 base point cut would probably even increase the 10-year Treasury, because people would say, oh crap, they're going to hold for longer, higher. You know what I mean?
So it's kind of a crazy dynamic.
But if they did like a 1%, then the 10-year would probably drop, because they're saying, oh crap, the Fed thinks the worst is coming. So that's my only thought.
What's going to happen?
Well, there you have it. There's our quick little recap of what we think is going to happen over the next few years with the residential housing market across the U.S. Thanks for joining another episode of the Cashflow Quest.
Till next time, comment below. We want to hear what you have to say.
Thanks, everyone.
Bye.